All right, let's continue on here. We're talking with Gary. Gary, you're with Allworth's Money Matters.
Hello, how are you guys doing?
We're good.
Okay, so I am retired for about 8 years now, and I have two pensions. One is I have a small pension and a tiny pension.
Okay.
All right. Those are all relative.
Those are all relative. The last year, the tiny pension, I got notification that the company, in their infinite wisdom, went out and purchased an annuity for me.
Okay.
In lieu of the pension.
Okay.
And that seemed to go off pretty smoothly without a hitch. They matched up the...
Gary, can I ask you a question? Did they offer you a lump sum at that time, or did they just say to you, this pension is now coming to you from X insurance company?
They just announced that they had purchased the annuity.
Okay, perfect. Okay.
They matched up the survivor benefits, with the pension. So
okay.
That happened very smoothly.
So it was really a wash. So instead of this pension fund sending you a check each month, they said, we outsourced this to an insurance company. We gave them the pile of cash in exchange for now they are responsible for providing you that monthly check. Is that right?
That's right.
Okay.
So
wait, I'm sorry. One more question here. What is the monthly amount? The
monthly amount for the tiny pension
the one that we were just talking about. What was that? Is that the tiny pension?
That was under $1,000 a month.
Okay.
Like I said, relative. I don't think most people's.
So here's the. I'm just going to go off here. Did they mention anything about the Pension Benefit Guaranty Corporation there?
No.
Okay, so tell us. So this went smoothly. Continue on with what's happened. Is this the same organization, or was this a union plan?
No, it's not a union plan. The tiny pension was that company was a spinoff from the other company.
Okay.
Okay.
So tell us what's transpired since.
So what's transpired since is that the parent company, the small pension, as opposed to the tiny pension. Now the small pension wants to do the same thing. And
how much are you receiving from the small pension?
The small pension is about $3,000 a month.
That's not small, by the way.
How old are you? I still, when he first said that, I said it's all relative.
It's all relative.
How old are you?
I am 68.
So that's hundreds of thousands of dollars, by the way, if I use the net present value of your life expectancy. Hundreds of thousands.
I know I am a blessed person.
Okay.
To have these. So the small pension, the one that's about $3,000 a month, and those pensions, the two together, that's a third of my needs. Yeah.
So what's happening with the company and the small pension?
Well, it's going to be, it's going to go into the annuity later in the year. But now I did make some payments into that pension plan.
Okay.
So the payments that I get from them, maybe 5% is
de minimis then.
Okay, 5% is return of principal.
Okay.
I don't know the exact term, but I'm just really wondering with these pensions in lieu of, or with the annuities in lieu of the pension, that no longer falls under PBGC.
That's right.
I don't know.
I'm pretty sure that no longer falls under PBGC.
Do they give you the opportunity to
take
the lump sum?
Did they at any point in time?
When I retired, they did.
Okay, and how about now?
Yes, how about now? Because you elected the pension.
Because what I've seen in the past is when these happen, they give the retiree an opportunity to take a lump sum. The company's just they don't want it to risk anymore. They're like, we're going to outsource this. We'll just give you a lump sum. If not, we're gonna buy an annuity.
Sell this to an insurance company.
And the company has done this selectively over the years. I've been just aware of it from talking to other people, where they'll take a chunk of retirees and they'll say, this chunk of retirees, are going to get the annuity in lieu of the pension. And like you say, to move that off their books. But I'm wondering, how should I think about it in terms of, like, should I make any changes to my overall portfolio?
It's so the question I have, which is I asked early on the what you call the tiny pension, which is, would the PBGC still come across? And if you didn't get the election for a lump sum,
then you would think that the company can't just shed the liability.
That's right.
We're not arrest attorneys. We're not pension attorneys. So we're not.
But that's what.
But usually, I mean, when I've seen this in the past, there's always been the opportunity, because the company doesn't care.
That's right.
They just assume you take the cash and get out of here if they're trying to dissolve this.
Yeah, because they might be backstopping the annuity on a risk pool at some point. So the question is, what are the annuity companies they sold them to? Was it Backwater Insurance Company, or was it
No, they were both. One is rated A or A minus.
You could tell us the name.
Well, one is American United Life, and the other one is MetLife.
Well, MetLife's massive.
Yeah. And American United Life is they're sort of regional.
Yeah, but is the small one, the 3,000? Is that going to MetLife?
Yes.
All right. So the question,
I'm not worried about that.
Okay.
But I am. The question is, how do I think about that in relation to my other?
Well, here's one way to think of it. So, years ago, there was an insurance company called Executive Life that they went and bought a lot of pension plans. This was back in the 80s. Remember this, Pat?
Ivan Boesky.
Was he part of investment?
Michael Milken.
Michael wasn't part of Executive Life.
No, that's what they were selling the pensions to. So they were selling all
these junk bonds.
Yeah.
So what happened? These insurance companies, that's right. They were buying a bunch of junk bonds.
They were raiding the pensions, which is, if you watch the movie Wall Street, when Gordon Gekko says greed is good, and they were actually going in and bought Blue Star, the airline, to raid the pension.
They were doing this exact thing.
They were doing the exact thing.
They had an overfunded.
Yeah, and Pan Am went. I think Pan Am was it Pan Am going to Executive Life or one of those?
Yes.
And then when the insurance companies went bust because they weren't diversified and they were all in one particular area, and so as a result of that, regulations changed dramatically for the insurance companies on how they had to invest their own reserves. They couldn't just go willy-nilly, and so they had a lot of restrictions going forward, which added a lot of protections for policyholders, annuitants, life insurance holders. And then secondly, most states, there's some sort of insurance pool where they, not like FDIC insurance, but the insurance companies all kind of agree to insure one another.
And the smaller the annuity amount, the more the insurance actually kicks in, not the other way around. So,
but those state guarantee associations or don't they have a limit? Like
that's right. That's right. It's like $250,000 or something.
Yeah, that's why I said the smaller the amount, the better the insurance, not the larger. So your question is, how should you view the rest of the portfolio? How big is the rest of the portfolio, and are you taking income from it?
Yeah, I am taking some income from it. It's about 2.5.
And how is it allocated now?
About 70% equity.
And how much income are you taking from this 2.5?
I'm taking like 1 or 2%.
I wouldn't change a thing.
I wouldn't either. I mean, assume one of the challenges, Gary, as your account balance goes up, the swings on a percentage basis result in much bigger dollar swings, right? So when you've got $250,000 saved and there's a 10% swing, it's $25,000. When you have 2.5 million saved, there's a 10% swing. That's $250,000. So we just need to make sure we've got eyes wide open, realizing that the markets, as they go through their cycles, and historically we've had a 20% pullback every 3.5 years, if you go back about 100 years. So these are very normal. Just that account's going to swing a lot. Now, if you're only pulling 1.1 to 2% a year, you've got income coming in from pensions.
And you've got Social Security coming in.
This is very high, highest probability of great long-term success.
But in saying that, I would make some changes.
I'm listening.
I am too. What changes?
I would look at doing Roth conversions.
I looked at Roth conversions and I kind of decided, you know what, it's a wash.
Was 2.5, is it all in the 401k? IRAs, 401ks?
Pretty much. It's like 90%.
And how old are you again?
68.
I'm 68.
Yeah, I would too.
I would absolutely be. You're the perfect candidate for it.
Because your withdrawals are going to double at 73.
Yeah.
73, 75, whatever it is.
75 at 68. Yes. If you were 68 years of age.
Oh, you're talking about RMD.
Yes.
Yes. So what happens is that I'd look at this and I'd go, okay, I'm at 2.5. I'm taking a 2% distribution today, right? So.
And now I'm going to be at a 3.8% or 3.6% or whatever the number is. At 75, it's probably closer to 4%.
Yes. So then I would actually extrapolate out a return. I'd just throw an 8% return in there, minus the 2%, compound that 6%, right? We're going to go out 7 years. You look at that account as $4 million. You're going to start taking $160,000 a year out of there rather than $50,000 a year, right? And then we've got Social Security on that. All of a sudden, your income's over $200,000 a year. And so you're going to drive your Social Security tax up, your Medicare premiums up. There's all kinds of things. Your income will more than double in those years. And so the time between the age of 68 and your required minimum distribution it's the golden hour for Roth conversions. And
that's a whole different thing for me. I looked at it, and the way I looked at it, it was a tax arbitrage, and it was kind of a wash. But I do some conversions mainly just to have a pile of money that I can get to without
how much conversions do you do?
Like try to do 15 a year or 30 a year.
I'm just telling you. But then look, I don't care what you looked at, Gary. I don't really care. You called and asked us about your situation.
That's the one thing I would recommend as well.
And I think you're fine on the annuities, right? And in the pensions. You're just missing an incredible opportunity. An unbelievable opportunity.
And it's because you've got a significant amount in retirement account assets, and you're barely taking any income from it.
Look, if you were a client of mine and I'm sitting in a room and you push back at me like that, you know what I'd say to you? What are you paying me for? Why are you paying? I'm giving you great advice here and you're not taking any of it? And yet you pay me? You took the time to call our program, ask for advice?
Pat, you sound like you're taking this personally.
I do, because he just completely discounted it, Scott. You just said, I looked at it and just a pile of money. I'm just telling you, you're wrong.
Well, I'm listening. I'll take another look at it.
I would take another look at it and do some run some long-term projections.
You have to run the long-term projections so that...
What does my financial life look like 5 years, 10 years, 15, 20 years out?
And you said the right thing. You said, well, I just saw it as some tax arbitrage. And I said, exactly right. And you're doing some tax arbitrage. You're just not doing as much as you should be.
Well, so when you talk about doing Roth conversions, what I have heard is that, that you convert up to whatever tax bracket you're in.
Yeah.
Maybe sometimes more.
Maybe.
Well, in my case, it would have to be more because I'm at the top of a bracket.
That's right. That's okay.
But I think I'll be in a lower bracket when I retire.
I'm just telling you, you won't.
Are you working today?
When I'm fully retired.
How much income are you earning today?
I'm not earning any income today.
Okay, then you're fully retired.
You're fully retired.
Yeah, you're right. I am. My wife is still working though.
What does your wife make?
She's around 120.
Okay. All right. That's new
information. Yeah.
That's some new information. The minute your wife quits, your wife quits, you should do Roth conversions. You probably shouldn't be doing any at all now and not even $15,000.
So you mean I've been doing it right?
Yeah, correct. I don't think you should probably even be doing, maybe if you got a little room in that tax bracket, but that's new information. We were under the assumption that there was no earned income coming in the family.
Got you.
Right?
Yeah.
But
No,
the minute your wife quits, the minute she quits working, by the way, you should have her work as long as you possibly can.